In 2023, a hedge fund you've probably never heard of paid its average employee more than $1 million. Not its partners, not its executives, its average employee, including the people answering phones. That fund is called Renaissance Technologies, and its flagship portfolio has returned something like 66% a year, before fees, for over 3 decades. Warren Buffett, arguably the greatest investor alive, has never come close to that. And here's the part that should actually bother you. Almost nobody at Renaissance is a stock picker. Most of them are physicists, mathematicians, and, increasingly, machine learning engineers. They don't read earnings calls. They don't have opinions about CEOs. They feed decades of market data into models and let the models find patterns no human would ever notice, then bet real money on those patterns thousands of times a day. That's not a fluke or a one-off genius fund. That's the tip of something much bigger. Right now, quietly, without press releases or Super Bowl ads, a meaningful chunk of Wall Street has already handed the wheel over to AI, not AI, as in a chatbot that helps an analyst write a memo faster. AI as in the thing actually deciding what to buy, what to sell, and when. At a speed and scale no group of humans could ever supervise in real time. And I want to walk you through how that actually works, because the mechanics are genuinely fascinating, a little unsettling, and they explain a lot about why the market has started behaving in ways that confuse even seasoned traders. Let's start with what these funds are actually doing, because AI trading is a phrase that gets thrown around so loosely it's basically meaningless now. There are really 3 different layers here, and most people mash them all together. The first layer is the oldest one, quantitative trading, or quant funds. This has been around since the 80s. Renaissance is the godfather of it. The core idea is simple to say and brutally hard to do. Markets are not random. They have subtle statistical patterns, and if you can find those patterns before anyone else does, you can profit from them again and again in tiny amounts at massive volume. Think of it less like betting on a horse race and more like running a casino. A casino doesn't need to win every hand. It needs a small, repeatable edge applied across millions of hands, so that over time, the math wins even though any single bet is close to a coin flip. That's what a medallion-style model is doing with milliseconds of price movement instead of blackjack. For a long time, quant meant statisticians building formulas by hand. What's changed in the last 5 to 10 years is that machine learning took over that formula building process. Instead of a human hypothesizing, maybe stocks that dropped on high volume tend to bounce back, you give a model enormous historical data sets and let it discover thousands of these micro-patterns on its own, patterns too subtle, too short-lived, or too weird for a human to ever have guessed. The model isn't told what to look for. It's told, here's 20 years of price data, here's what happened next. Each time, go find the relationships. The second layer is where it gets stranger, and this is the one most people have no idea exists: alternative data. Funds like 2 Sigma and Citadel aren't just watching stock prices anymore. They're buying, legally, through data brokers, things like anonymized credit card transaction data, satellite images of retailer parking lots, shipping container tracking, and even scraped job postings. Picture this. Before Walmart's quarterly earnings even come out, a fund's AI has already looked at satellite photos of parking lot fullness across thousands of Walmart locations and cross-referenced it against credit card swipe volume. And it has a fairly good statistical guess of whether earnings will beat or miss, before a single human analyst has read the report. By the time the earnings call happens and a retail investor reacts to the news, the AI already traded on it hours or days earlier and, in some cases, is already selling into the reaction. The third layer is the newest, and it's the one that's exploding right now. Large language models being used not just to trade, but to research. Funds are pointing AI models at thousands of documents. SEC filings, court records, patent applications, even Reddit and X posts, and having the AI summarize sentiment, flag red flags in footnotes, or catch subtle language changes between a company's last 10 quarterly reports and this one. A human analyst might cover 20 companies well. An AI can effectively read and cross-reference every public filing from every company in an index every quarter and flag anomalies for a human to sanity check. It's less robot trader and more like giving every analyst a research assistant that never sleeps and has memorized the entire internet. Now here's the question that actually matters, the one worth sitting with for a second. If this stuff works this well, why haven't these funds made all other investors obsolete? Why is there still a stock market at all, instead of just 3 AI funds trading against each other forever? There are a couple of real answers, and they're more interesting than regulation stopped them. First, these edges are self-destroying. The moment a pattern gets discovered and traded on enough, it stops existing, because the very act of exploiting it moves prices and erases the inefficiency. This is why Renaissance's Medallion Fund is famously closed to outside investors and capped in size. Even they believe that if the fund got too big, its own trading would eat its own edge. So these funds are locked in a permanent arms race against each other, not against retail investors. Every AI finds something, another AI finds it a few weeks later, and the edge shrinks towards zero. It's an evolutionary pressure that never stops. Second, and this is the part that should genuinely make you a little nervous, nobody, including the people who built these models, fully understands why they make every individual decision. A machine learning model with millions of parameters isn't following a readable rulebook like sell when the PEE ratio exceeds 30. It's following a mathematical structure so complex that even its creators can only really evaluate it by its results, not by tracing its logic step by step. That's fine when it's making money. It becomes a serious problem when something goes wrong, because you can't easily ask it, why E? It just did what it did. And that's not a hypothetical. In May 2010, a chain reaction of automated trading algorithms, not even the sophisticated AI kind, relatively simple ones, caused the Dow Jones to lose almost 1,000 points in minutes and then claw most of it back, all before most humans even realized what was happening. That event has a name now, the flash crash. It's the ghost story every quant fund tells, because it proved that when enough automated systems start reacting to each other's reactions, you can get a feedback loop that no individual model intended and no human can stop in time. Now imagine that same dynamic, except instead of relatively simple rule-based algorithms, you've got large language models making judgment calls based on interpretations of news and sentiment, reading the same headlines at the same time, and potentially reaching similar conclusions simultaneously. Some researchers who study market stability genuinely worry that widespread AI adoption in trading doesn't just add intelligence to the market, it adds correlation. It makes a huge number of independently built systems more likely to move in the same direction at the same moment, which is exactly the condition that turns a bad day into a crash. There's one more layer to this that most explanations of AI hedge funds skip entirely, and it's the one that tells you where this is actually headed, who these funds are hiring. Renaissance famously doesn't want MBAs. Its hiring pool for decades has leaned toward people with PhDs in physics, astronomy, and cryptography. People who spent their careers finding faint signals buried in noisy data, whether that data came from a telescope or a stock ticker. The joke inside the industry is that a top quant fund would rather hire someone who spent 5 years modeling the cosmic microwave background than someone who spent 5 years on a trading desk. Because the actual skill being hired for is, can you find a real pattern in an ocean of statistical noise without fooling yourself? Trading experience, it turns out, is almost beside the point. That hiring pattern has quietly reshaped an entire generation of scientific talent. Astrophysics departments have watched some of their best graduate students get pulled toward finance, not because they suddenly cared about markets, but because a hedge fund would pay them 4 or 5 times an academic salary to point the exact same statistical skills at price data instead of starlight. It's a strange, largely invisible brain drain. Theoretical physics' loss has been Wall Street's quiet gain, and it's part of why these funds have gotten so good so fast. You're not just throwing more computing power at the problem. You're throwing some of the sharpest pattern recognition minds on the planet at it too, and giving them a much bigger paycheck to do it. There's also a newer, weirder experiment worth knowing about, because it shows where this might go next: crowdsourced AI hedge funds. A fund called Numerai takes this to its logical extreme. It publishes anonymized, encrypted market data to thousands of data scientists around the world, most of whom have never worked in finance at all, and lets them submit machine learning models blind, competing against each other for a slice of the fund's profits. Nobody submitting a model even knows what stocks the data represents. It's a hedge fund run less like a Wall Street firm and more like an open-source competition where the traders are just whoever built the best performing model that week. It's a small fund in the grand scheme of things, but it's a live experiment in something bigger. What happens when trading talent stops requiring a finance background at all and just requires being good at machine learning? So where does that leave an ordinary person, someone with a retirement account, and zero interest in building a hedge fund? Honestly, you were never meant to compete with Renaissance technologies, and that hasn't really changed. What has changed is worth understanding. A growing share of daily trading volume is now algorithmic and AI influenced, which means a chunk of the price movement you see in your portfolio on any given day isn't humans reacting to news. It's models reacting to data, in a loop that happens faster than any person could follow, let alone predict. That doesn't mean the game is rigged against you. It means the game has quietly changed shape. The wild short-term swings that used to require a rumor and a trading floor full of humans can now happen because 2 AI systems both decided, independently, in the same 11-millisecond window, that the same obscure pattern in shipping data meant something. And most of the people whose retirement accounts move because of it will never know it happened. Which is maybe the strangest part of all of this. We tend to picture financial power as loud. Men in suits ringing a bell, shouting on a trading floor. But the actual center of gravity in modern markets has moved somewhere much quieter. Server racks in New Jersey and Chicago, running models that nobody watches in real time, making millions of decisions a day that no single person could explain if you asked them to. It's not that AI is coming for Wall Street. In the parts that matter most, it already quietly arrived, and it's been running the place for longer than most people realize.